Let's get started. Here's our updated agenda, as I do and have done for quite some time now. We will touch on some macro topics that are impacting markets, the positioning we've got in portfolios for the remainder of 24 via some themes, a little bit about the stock market and where that's trading at the moment, a little bit about how bonds are impacting this view, and then we'll wrap it up there. We don't have a special topic this time because we've actually just not had a lot of client contact. So if there are any topics you would like to know more about, we can certainly potentially add that as a slide at the end in the next Market Matters. So this brings us to kind of the slow summer months. We do think it's probably going to be a bit slower in markets than usual, just given what we've got in front of us. And I think some of what's framing some of this idea is that we've got just a kind of a ho-hum season of reports coming out now. We've gotten CPI behind us. Fed meeting is actually in front of us, but we think it's probably going to be a pretty benign meeting. And then you've got what we've got here, which is reports on both the manufacturing and the services sector. This does, in our opinion, help frame, the direction of the economy more broadly. And I think, just kind of what you're seeing here, as we pointed out, is a broader based deceleration into the summer months here. Nothing too impactful, nothing too significant. There has been a slight drop off on the manufacturing side. You can see the orange line there. And for reference, any number below 50, so it's at 48.7 as of last month, means there's a slight contraction in the manufacturing sector. And the services sector, which is in that purple line, has slipped into a contractionary phase. I think we get the monthly read for services from last month tomorrow. But, our expectation would be probably banging around these levels for the better part of June, July into August, with September kind of filling that historical pattern of people coming back off vacation, economic activity starts to pick up, and kind of right into the teeth of the election season. But I guess the punchline here is we're still kind of in this stalling phase, if you will. Nothing too bad, but nothing too great either. Housing, we did get the updated numbers around housing as it related to March. And you can see here, despite the fact, so the Case-Shiller 20 home index, composite index, is in that purple line shown in the year-over-year rate of change. And then the 30-year mortgage is in that orange line. And again, notably, despite the fact that mortgage rates are at or near 30-year highs, the housing market has remained pretty resilient, just due to a combination of, I think, excess savings, but also limited supply. Home supply is still very much in a shortage, and coupled with that regulatory aspects, it does kind of add up to a bit of a asset class that does appear to be at the moment bulletproof, if you will. So we don't really see any change in housing anytime soon, which does reflect a lot of the wealth effect of what people feel. I like to show this chart. This is the second kind of month in a row we've showed it, because it just shows you, as opposed to maybe previous months where there was a little bit more going on. This chart right here shows you the VIX index, which is that purple line, the S&P VIX index, and high yield bond spreads. Both are a proxy for complacency in markets. And I think what you can see here is we've kind of settled into a new lower level with both of these indices, and it just kind of suggests that we're going to be in this slower period for markets, not really going anywhere, but just kind of banging around current levels for the time being until we get the next earnings season, which we're just getting through the very end of Q1. Q2 earnings reports should come out sometime toward the latter part of July into early August. And like I said, that's about when we'll start to see stocks probably move a little bit more. Important to note, we are in an election year, and just kind of where we sit, this is not a political statement by any means, but this is from the betting site 538. So they take not a betting site, it's an aggregation of national polls being done on a daily basis. So this will update as information comes in. And I think the only point I wanted to show here is that as the title suggests, election year fireworks, is that despite the fact that, and this is June, as of June 3rd. So despite the fact that we have had the conviction of Donald Trump on 34 counts of felony charge document manipulation, he is and remains the front runner, and that's just, I think, going to be setting up for some really interesting activity as we get closer to that November timeframe. But so we'll have to see. There's still a lot of road to hoe there on what the actual sentencing is going to look like in terms of the sentencing, but we'll have to just see how this evolves over time. One thing I did want to just point out, it's a quick view of where the U.S. sits now with relationship to all the other energy producers in the world. And I think this is a great chart to show, because this week, OPEC Plus, which is many of the Gulf regions, Saudi Arabia being the largest one, including Russia, did agree to supply increases. This actually surprised the market a little bit, sent oil prices down probably 3 to 5% over the last 2 days. But all that in context is that still the U.S. remains pretty easily the largest energy producer, and the benefits that accrue to us as a independent energy producer will be pretty meaningful, even despite these production cuts and what's going on with Russia, Ukraine. So a source of positive economic activity that really has nothing to do with some other actors around the world. This is a standout area for opportunities, and certainly areas we've taken advantage of in our own portfolios, particularly around the energy side. And that brings us to just some of the big picture ideas for remainder of 24. And I think as probably in July, we'll start talking about early look at 25, some of the thoughts there. But, again, these, I know they look very similar, but we do update these comments. And, there is, as some of the activity in the services and manufacturing sector suggests, there is some trouble under the surface, but until which time it shows up in company earnings, we're not going to get too concerned about that. Politics does not equal financial market outcomes. So we'll show a slide on that again, but we have some additional data to provide showing the actual returns of election years themselves, which I think you'll find interesting. There is some complacency, no question about it. We are being much more scrupulous on some of the new positions we decide to take, or maybe being a little more flexible around some of the trimming we decide to do around individual companies, but also portfolio positions. And so we want to make sure we're being mindful that there is some complacency. With that in mind, we need to potentially start taking some positions out of the portfolio or trimming back. And then again, this is the big one. It should probably be the one in the upper left-hand corner, but the Fed on hold does not mean we're in the clear, because we are setting up for a situation where the Fed is essentially backed into a corner. The market still expects the Fed to cut rates between 1 to 2 times this year. This is, of course, despite the fact we have inflation still running at 3.5% or so, and houses appreciating at 7%. And it just sets up for a really binary outcome, because if the Fed, which meets later this month in June, decides not to cut rates, which is the expectation, then that means that they would have to cut rates sometime either in advance of the election, which would not be a good practice, in November, or in sometime in late December. And squeezing 2 cuts into December, I think, would be really tricky and could surprise the market in a bad way. So we're being mindful of what they're saying, but we certainly have to watch their actions to see how it's all coming together. This chart it looks pretty similar to the last time we showed it. Our positioning really hasn't changed for the better part of the year, once we got our bond portfolio pretty short in duration and our alternative positions in place. So for the time being, we really haven't made a whole lot of changes. But again, I think being mindful of tactical opportunities as they become available, certainly during a low volatility, complacent market action, is something that we want to take advantage of if at all possible. Just here's a look at where we sit, stock prices in the US through May 31st. Again, quite a bit of differentiation. Small cap really can't find any reason to rally. Barely positive for the year through May 31, up 1.9%. I think there is definitely some negative aspects going on with positions graduating out of the small cap indices, or complications arising because of a lot of the SPAC activity that occurred in 2021, 2022. So we continue to have no exposure to the small cap sector, with a very small exposure to the mid cap sector, which I do think is very attractive, and for our portfolios has been actually very additive this year. You can see the very, I wouldn't say super wide, but a pretty decent difference again has emerged between the growth index and the value index. So this is the 1,000 largest companies on the growth side and 1,000 largest companies on the value side. And you can see there's about a 5 percentage point difference between those two indexes. A lot of that just, I think, has to do with forward projected growth rates and earnings that are coming through. Because you would think that if interest rates have been rising this year, which they have, going from 3.8% or 3.88 at the end of 2023 to where they are today, which is about 4.3%, you would think that would have some impact or implication on valuations within the tech sector. And so far it hasn't. And I think a lot of it has to do with the fact that these very large tech companies, just think Microsoft, Meta, Google, Apple, are all pretty much self-funding, meaning that they don't have to access debt markets for capital needs. And that is a big benefit for some of these largest companies, which are also some of the most profitable companies. So for those that have been following what we've been doing in our portfolio, we still have a pretty sizable exposure to technology across a number of different names in our single stock portfolio that has really helped us generate outperformance this year so far. And then, we're just about through earnings season for Q1, and we'll give an update for this. We showed this slide last time, but again, if you're wondering why the market is up, call it 11% this year, versus the expectation, our expectation was kind of mid to high single digits. It's because of right here, earnings continue to surprise to the upside. So what you're seeing here is what the market expected the S&P earnings to be up 3.4% as of March 31st. They've actually come in a little bit above 5. If you were to market today, I think it's about 5.8. So the difference in 3.4 and 5.8, in our opinion, accounts for a majority of why the S&P is up in the double digits so far this year. And this will have to continue on. So far, companies like Meta, Nvidia, and some of the big bellwethers have all been able to deliver on earnings. And that has really carried the markets to new highs or close to new highs. And then the other piece of it is, like I just mentioned on the previous slide, this is the number of companies that have positive changes in their forward-looking earnings. So this is, when companies issue guidance to the market, they are generally showing guidance that is in excess of what they previously thought. And so what this is saying is, as of May 10th, this is a little dated, but as of May 10th, roughly 80% of companies are telling the market that their earnings will be better in the next quarter than previously. So this is a big, again, reason as to why we've been pretty bullish on the market so far this year. Earnings have been surprising. And in that way, we can't necessarily be, taking our chips off the table on the equity side. More, our preference would be to maybe, if we're going to be trimming companies, adding to new positions that we find attractive at interesting starting points, and just going through that regular portfolio management process, as opposed to scaling back any equity exposure. And this is a chart I just wanted to share with everybody about earning S&P returns during election years. Well, S&P actually didn't start until I think it was the mid 70s. So these returns are actually of the Dow Jones up until this point, and then it was S&P forward. But what you can see is a pretty one-directional picture, meaning that in election years where the actual election occurred, the average return during those years, and in the years where it was positive, was 17%. Average return in a year where the market was negative, that's 4 out of these. This instance was negative 16. But if you strip out the GFC, it's only 9. So we feel like we've got a pretty decent risk reward coming into this year as well. And from here, probably not too terrible with the plus 17 versus a negative 9. That's basically a 2-to-1, and that's what you would like to see as far as projected returns go. And of course, the average, only 4 out of, I think this is 20, 26 periods, leaves us with a pretty high batting average for election years. 25, however, I think is much more to take issue with, because that's when policies will start to be implemented or put forth, and I think that is a whole different ballgame. But we'll touch on that as we get into July. One reason that earnings continue to surprise the upside is, even despite the fact that we've got rising labor pressures, companies have been pretty resilient in their profit margins. And so what you're seeing is a picture of S&P 500 net profit margins of trailing 4-quarter average going back to 1990. And what you can see is just this relentless push higher in profit margins as companies have done everything in their power to make their companies more profitable, which ultimately leads to earnings, which then allows for stock prices to reflect those earnings. And I don't really take issue with what Goldman says here versus consensus. It's really 6 in one hand, half dozen the other, in our opinion. But I think the point is here is that companies have found ways to become more profitable as time goes on, and we don't really see that changing, particularly when you think about the advent of AI and how that will likely turbocharge profit margins into the future. Just, another thing we just like to look at every now and then is the underlying, internals of the market fundamentals. And this is what you're seeing here is a number of S&P stocks that are above their 200-day moving average. So 200-day moving average is just basically a full trading year, showing you essentially how many of those companies, actually it's not a full trading year, I think it's like 10 months, of how many of those companies are actually above that long-term average. So around 70, it's a pretty healthy number, even though it's been decelerating a little bit since the beginning of the year. 70% of S&P companies are still above their 200-day moving average. So that gives some nice technical support to the market. However, we do want to just point out, this is the 50-day moving average. It's a shorter term window of time. It's about a 3-month trading window, or 2.5, 3-month window of time. And what you can see here is that actually that number of companies trading above their 200 days is moving lower. So when these things start to diverge is where we start to take notice. Momentum over the short term is declining and falling, which is notable. Probably the market just looking for the next catalyst. Nothing too catastrophic quite yet, but we'll certainly be watching how these two dynamics interplay and evolve. Now let's turn to bonds. Bonds have, similar to last month, had another tricky year where anxiety on the long end, call it the 10 to 30-year bonds, is really coming through in the price performance of the overall bond index. So this is as of May 31st, but you can see the overall bond index that we measure our portfolio against was down 2.8, almost 3%. I'm happy to report that most of our portfolios have fared far better than this, to the tune of 1 to even 1.5, maybe 2 percentage points. So we're doing quite a bit better because our duration has been much shorter. We're basically cutting out a lot of this pink line from our portfolio that we've always thought since the beginning of the year has been a bit of a problem for the market. We don't own it, and furthermore, we've been able to maintain exposure, or a very positive relative performance, all the while not having any explicit high yield or emerging market debt exposure, which is actually the two categories that have done the best this year, at only down fractionally. So we're very happy with how we've been positioned, but I think the idea we still have here is that we're not out of the woods yet on the inflation side, and that it's better to be cautious, because this pink line moving around doesn't take a whole lot of interest rate movements to get this price whipping around. So we're gonna sit that piece out, but recognizing that if yields on the 20-year Treasury, 30-year Treasury get up to double digits again, like they did in the late 70s, early 80s, then that might be the time to step into some of these long bonds, because then you're achieving equity-like returns. Just one thing to note, another reason to be a bit cautious on bonds here is that this is what you're seeing here is the 12-month rolling correlation between stocks and bonds. Typically, what most modern portfolios are based on is a negative correlation to stocks and bonds, which means that if stocks are falling, then bond prices are rising, and vice versa. If stock prices are rising, then bond prices are generally falling for the right reasons. Because if bond prices are rising, that means that yields are falling. And if bond prices are falling, that means yields are rising. And so what we've kind of pointed out here is that we're at a new kind of 20 plus year high for the stock bond correlation, which means that there's really not a great reason to own long bonds here because they're not providing with that diversification benefit of negative correlation and portfolio offset. What they are providing, though, especially if you own the short-term bonds, is income and capital preservation. And that's been exactly how our bond portfolios have been constructed right now, which is capital preservation first, income generation second. And we're actually benefiting right now because the yield curve has shorter term bonds yielding more than longer term bonds. So we're winning on a couple of different fronts right now. But we are going to be waiting for this line to change directions, maybe back down to a much lower level of correlation before we get more aggressive in the bond portfolio. It's worth noting that this kind of search for yield globally is still ongoing, and it's not a US phenomenon. What you're seeing here is the bond spreads to the comparable treasury globally, showing that everyone around the world is looking for high yield opportunities. And so whether it's in Europe or Latin America or emerging Asia or the US, high yield bond spreads continue to grind lower because number one, economic data has been pretty supportive. It actually looks like areas like China and Europe could actually be turning around and going in a positive direction on the growth side. So that's allowing investors to be less compensated for high yield or more speculative bond risk. But because high yield bond spreads are going down, that does signal that investors globally are still willing to take on more risk. And I think that, like I said, that's probably going to not change until we get closer to Q2 earnings season or US election time, where you've got more catalysts for change. And so just wanted to sum it up here. We did want to give you some time back here because this is a summer update. And like, again, I know everyone's got busy summer plans, but I guess the couple of takeaways here. Number one is sleepy summer is likely to persist in the absence of any major geopolitical unexpected events. And base case for us right now for the foreseeable 60 to 90 days is that market's going to be churning on the S&P side right around these levels with no really large swings in either direction, because there's just not a catalyst for that right now. Again, now is a great time to be managing risk, particularly with the complacency that's starting to creep into markets, and trimming off positions, looking for new opportunities that could be a better value is something that we're doing right now. And we have been doing for, at the inception of the strategy. As I mentioned, it's bonds for liquidity or capital preservation, income second. So while there are opportunities in more, I would say, spicy parts of the fixed income market, we're not necessarily willing to take on a lot of those quite yet because the compensation, as I just showed, isn't significant at the moment. And then on the alternative side, we're really happy with how the performance in our liquid alternative sleeve has performed, in addition, to some of the private funds, of course. But as of May 31st, the performance for this liquid alternative sleeve sits somewhere right in between stocks and bonds with very low volatility, and that's exactly how we constructed it, and something that can provide portfolios with very nice diversification in the event that things start to break loose a little bit for one reason or another. Needless to say, we're very happy and pleased with the way our portfolios have performed so far. I know our advisors are reaching out to give updates on what we're up to, but if you do have any questions in the meantime, please feel free to reach out to me or your advisor. We'll get back to you as soon as we can. And with that, I think we'll call it there. And we'll look to see you next month, sometime in July, for the next Market Matters. Take care, everybody.